The Central Bank of Nigeria is scheduled to offer about 148 billion naira across the standard maturity at today's primary market auction. Traders at Access Bank say they expect the auction to be oversubscribed, while rates will slightly decline. The bank's team lead of currency trading, Adama Bachu, joins me for this conversation. Adama, welcome to Power Lunch West Africa. So what informs projections of oversubscription of the PMA expected at the markets?
Yeah, thank you so much for having me. Like you said, there will be PMA auctions today, and of course, the offer is actually below what has been subscribed, like you said. Given that, we expect the CMO to offer about 140 billion today, and then because of the increased demand in that sector, they may not be able to meet up with that demand. Hence, we have a lower offer vis-a-vis the subscription. So we also expect the rates to come out much lower than what we had from the last auction, where we saw 91 days closing at 1.1%, 182 days 1.5%, and 364 days closing at 3.05%. Well, I expect about a 0.05 basis point, a 0.2 to 0.05 basis point drop, given the level of demand in that space.
So, Adama, I just want to quickly go to the issue of the paucity of funds that reports say was witnessed at the investors and exporters window. How is that impacting activities so far?
Okay, so the paucity of funds in the investors and exporters window has been on for a while, given the challenges that we have in meeting demand in that space. We have the global pandemic of the COVID-19 and also a drop in the oil prices. So this has lingered for a while. However, the CBN has been consistent in their interventions. They have actually intervened continuously at the SME windows, and also they have started intervening at the I&E window, where they have been selling to the foreign portfolio investors. However, the rate actually traded flat to close at 386, and the rate has been at 386 levels in the I&E, but we still have a lot of demand in that space. So we hope to see improvement in intervention and then see a bit respite in that market.
So given that we have now seen 3 active days of trading in the market, it's safe to ask you for your projections for the market in the near term. What's your outlook? Okay,
I'll start by the FX market. We have seen the interventions in the market across the windows of the SME, the interbank, and of course the power market and the I&E. We expect the rates to remain at 386 levels in the FX market, in the I&E market. While for the money market, we expect rates to be trend a bit lower, given that it closed at 4.4% for the OBB and 5.2% for the overnight. Given by increased liquidity in the system, we expect, like I said, there will be almost maturities of about 348 billion coming, together with the NCD maturities of about 190. So this will actually cause a drop in the overnight and OBD rate in the money market. Also, in addition to that, we have also coupon payments of about 100 billion coming to the system. So for the fixed income space, we also see a drop in rates, also giving as a result of the high level of liquidity in that market. We will see the rates trending lower by probably a 0.2 or 0.25% across all maturities, both in the fixed income, both in the treasury bill market and the fixed income, the bond space. So we're going to really see a drop in rates driven by high level of liquidity in the market.
So, Adama, we've done Nigeria now. We've seen inflation figures. Neighboring Ghana, we've seen inflation figures. They are awaiting MPC decision for both of the countries. Let's now step out of Africa. By later today, we expect the Federal Reserves in the U.S. to have wrapped up their two-day meeting, which is actually the last time they will be meeting before the elections and the first time they are having the meeting since the monetary strategy shift that they had. But as that meeting winds to a close, what do you reckon the central bank, the U.S.'s central bank's new policy drive will entail, and what might investors be looking forward to getting?
My take, I feel that the Fed should hold steady on the rate at 0%, although there have been talks around stimulating the economy and trying to improve inflation. But however, you see that the country or the global economy is still, having the impact of the pandemic of the COVID-19 pandemic. And given that the U.S. economy is quite large, the economy is still fragile and still susceptible to shocks if there will be an increase in rates. Companies are coming up, economies are trying to revive. We have seen a drop in the employment rate, and so we see a bit of strain in that economy. So I feel that the Fed will have to, look for ways to stimulate the economy other than increase rates, to encourage the business segment of the economy to drive growth. Probably they'll go through issuing different stimulus packages, which they have already started, and providing credit to stimulate the economy.
Okay.
Because increase in rates will actually cause a strain in lending rates. We don't want to put a strain in that segment. So I think the U.S. economy, I think the Fed will look at how to manage the U.S. economy in such a way that the investors, there will be a cost in that segment, and also the economy will ramp up without having to pay more for loans and other form of credit.